Business Day Millennial Hangout. I am Ethel Adono, a social media strategist here at Business Day, and today I'm very much excited to be your moderator for this insightful conversation. Today's topic is financial literacy, projecting and investing for financial freedom. Today's topic is one that hits close home for most of us because the truth is we might not have been opportune to really we might not have been opportune to have been taught about how to save wisely, invest, or even grow our incomes. So as usual, Business Day is bringing this conversation right straight to you and is free of charge. So thank you all for joining us today. And of course, I am not here to do this alone. I've got brilliant speakers with me here today, and it will be my utmost pleasure to introduce them to you all.
Forward to a very meaningful and productive conversation. Thank you.
Thank you for being here. And lastly, we have Adeze Kingsley Anyango, Head Personal Banking Sector at Access Bank UK Limited. Thank you so much for joining us, Adeze. Please say hello to our listeners.
Good afternoon, everyone. It's a pleasure to be here today, hanging out with you, and I look forward to a productive session.
Thank you so much for being here today. Okay, moving on. I would like to give you a quick rundown of this section. So first off, we'll be taking a brief presentation from our speakers before we move straight to the Q&A section. So thank you for joining us. And of course, this is going to be an insightful one. So going forward, I would like to call on our first speaker, Adetayo Jinadu, to proceed with his presentation. Thank you.
Oh, thank you. Thank you, Ethel. I would just share my screen, just a second.
Okay. All right, so while we wait for Adetayo to share his screen, I would like to indulge us all. If you know a friend who needs to be here and is not here yet, please do well to share the meeting link with them, your family member, because this is an interesting topic. And of course, it's always a pleasure to discuss financial literacy because it's a topic that is very important in this our present day generation. So thank you for being here. Okay, I think his screen is up now.
Okay. Thank you. Thank you once again. So just a little brief. We've been given a little lesson and just been tasked to create little slides. For the most part, we're trying to make this presentation as short and simple as possible and straight to the point. The focus of the session is budgeting and investing for financial freedom. But to make sure we are able to cover enough topics in this little presentation, I am going to be focusing primarily on the investment aspect because I mean budgeting. There's loads of tools online for you to access. If you're listening in, everyone pretty much has an idea of the 50-30-20 rule. There's a lot of resources as well available, but on the investment aspect of things, it's a lot more complicated, and people might find it difficult to understand. So we'll be going into that in this presentation. So first off, as a rule of thumb for us at ZPress and ZPress World, we always believe that examples are literally the best ways to learn. So first things first, we would be going through this approach by presenting scenarios. And one perfect scenario we always use is if you had 10 million naira, where would you put it? Where would you invest it? You just luckily received 10 million naira from an uncle, from a friend. What should you do with that? So to give you a little time to think about it, would you put it in a bank? Would you put it in a fixed deposit? Would you find a money doubling scheme to put that money in. We'll present a few scenarios as we go through these slides and probably learn a few things as to what you should do if you have any sort of money, whether it's 5,000 naira, 20,000 naira, 500k, or 10 million that we have in this scenario. So, example one, scenario one, you are promised 30% yield in 90 days. This is an option, it's a viable option for certain people. But of course, we'll go through what could happen if you choose any of these scenarios that I'm going to mention here. Scenario B, you choose to put it in a bank. You promise a yield of 3 to 4%. Of course, here you promise safety as well. Scenario C, you choose to put it and invest it or keep the money in a fintech, which promises you 17% annually. And scenario D, you choose to use a tech licensed asset manager who is yielding about 15 to 21% annually. So what happens? These are the four scenarios again. A, 30% in 90 days. B, a bank, which yield 3 to 4% annually. C, a fintech, which will be 17% annually. And D, a tech license asset manager, which will be 15 to 21% annually. So what happens if you chose A? I am sorry to say, A, as we can see, is probably a pyramid scheme. If you are promised that you will get 30% in 90 days when the existing or current MPR rate is just about 27%, you should know that something is fishy. So first things first for lessons, um, when you're choosing to invest anywhere, you want to consider the risk and ensure that this interest rate or whatever rates they are giving you is actually possible. Understand what is being invested in, understand how they are calculating their rates, because most often than not, it's probably another Ponzi scheme, it's possibly another MMM, or as of recent, I can't remember the name of CBEX. So primarily, you want to ensure that you are choosing the right company to give your money to, or else you will end up like our brother here, who has to balance his Gary diet with some onions just to make sure that he can retain his sight. So B, choose to put it in a bank. Yes, you're guaranteed no, you're guaranteed trust. There's possibly nothing, the risk of anything happening to you. The money is next to none. But of course, you would only yield a little amount of interest, or next to nothing in a year. And of course, there's the current bank charges that us Nigerians always tend to complain about. C, fintechs. Not to bog down any fintechs, probably one of the greatest things to happen to Nigerian financial services space. But a lot of the times, these fintechs scale without any regulatory bodies backing them or being protected by any sort of compliance laws. And most often than not, situations happen where you could wake up and, for example, they've shut down as a result of some regulatory headache or issue that they've had. And usually what happens is your money is gone and you have to find ways to find a way to get your money back. And lastly, you choose to invest in a SEC licensed fund manager. Like our famous actor here, what this means, you are guaranteed returns, you are guaranteed safety, you are guaranteed happiness. So, why we've used that as an example, I believe some of the lessons in there should point us into certain ways we should be thinking when it comes to making investment choices. For the most part, I made an assumption that most people on this call would be early stage to mid-level investors just starting to think about investing. So the assumption is that you'll be risk averse. So which is why the scenarios we've used in the presentation so far also touch in a certain point. What amount of risk are you willing to let go of? So essentially, we are presenting you with what would be the safest option with probably the highest level of yield or highest level of returns. And with that, we'll go into certain opportunities that people would consider. As you would say, when we're looking at risk averse asset classes, you're usually probably going to be looking at options that would guarantee your return for the most part, guarantee your capital for the most part, and also guarantee your return. And most likely we look at Euro bonds and FGN bonds. So these are pretty much of the same kind of asset classes, just debt notes issued by the government. Essentially, it's when Nigeria is choosing, to example, fund the existing road that they're doing from Lagos to Calabar. They may have issued a bond, which again, these are a bit mid-term to long-term asset classes. They're debt instruments that the government might issue to sort of raise money from countries, raise money from corporates, raise money from individuals. And again, because my assumption is that people on this call are new investors to mid-level investors, you probably would not necessarily be choosing the Euro bond or FGN bond because the entry level is usually very high. You're looking at about 200 for Euro bonds at least because they are issued in a foreign currency, primarily dollars. You're looking at about $200,000 as entry level. However, there are situations where you can have $1,000 as the entry point. For the FGN bond, that's usually again it's also a large amount, 100 million naira, or about I think that's usually the minimum amount, and it's usually targeted at HNIs and corporates. But for people on this call, again, like I said, I'm looking for more younger investors or millennials, like we said, people that are just thinking about investing. The options you possibly should be considering will be treasury bills, commercial papers, mutual funds, and fixed deposits. So for treasury bills, essentially sort of like FEM bonds and Euro bonds, but these are more short term. So you're looking at about 60, 90, 90, 180, and 290 something days. Usually in about a year, you are able to get your money back. And why this particular asset class is favorable is because, like you said again, your capital is pretty much guaranteed because the government cannot necessarily disappear with your money. It's like choosing to lend your money to the Nigerian government. Nigeria cannot disappear in 2 days or tomorrow you wake up and Nigeria doesn't exist. It's highly unlikely, rather, I would say. So you're primarily guaranteed your return. For commercial papers, instead of it being the government now, you now have institutions and industrial companies, for example, like Dangote, Nigerian breweries, flour mills, or even tech companies as well. I think Piazza of recent, literally just paid off the debt notes that they raised last year, I believe. So what happens with commercial papers is just a flip of treasury bills. This also is short term. So in a year, you are able to also get your money back. Mutual funds, most particularly money markets, is where I will focus on. You're guaranteed your capital, and you're also guaranteed a particular yield depending on the market situation. The yield possibly could change. It's usually a reflection of what the NPR rate is. And fixed deposits, which you can choose whether from the bank or from any other fund manager or investment company of your choice. So again, why have I chosen those 6 options? Just to reiterate the point, I'm choosing those based on the fact that we are speaking to risk averse audience. If you're wanting to be guaranteed your return on money, wanted guaranteed capital, these are the options to consider. Of course, I haven't mentioned equities. That, of course, has a certain level of higher risk. But if you know what you're doing, if you're willing to put the necessary time, you can be guaranteed to make a good enough buck when you choose to invest in the stock market. I believe the the all-share index currently has been climbing considerably week on week. So, of course, a lot of questions will be asked. But again, you always want to make sure that you do your due diligence before you jump into anything. If you're a new investor, it's always best to start with risk averse assets like I said in this presentation, and your best options, the treasury bills, money market funds, commercial papers as well to an extent. And how ZQuest Wealth helps you. This will be the last bit of my presentation. What we've built is, or what we like to call it, is the best investment app on the planet, where essentially everything it is you might be looking to get, from fixed income instruments to debt notes, and also to equity, you can get it on the ZQuest Wealth app today. So we currently are top three with our money market fund, currently at an average yield of 21.45%. Minimum subscription amount is £1,000. We also have a dollar fund. You can also invest in that if you are looking to hedge your currency risk and would just want to invest in dollars. We also have fixed income fund as well. That again, minimum 90 days. You are also able to access treasury bills. You're also able to access commercial papers. And of course, you're also able to access equities if you are willing to take the risk. And why ZQuest? ZQuest Wealth is a subsidiary of the ZQuest Group. We like to consider ourselves the one-stop shop for financial services. Currently, we have 136 billion in funds under management as of December 2024. We're rated as the fastest growing financial company in Africa by the Financial Times in 2022. We also currently, total assets is 90 billion naira as of December 2024. And our brokerage firm has been the 4-time consecutive winner of the FMBQ award in Nigeria. Again, ZQuest Wealth is the youngest subsidiary in the ZQuest Group. The ZQuest has existed for 10 years plus. And that would be all for me a day in my presentation, just making sure I keep to time.
Thank you so much, Adetayo. That was so brief and enlightening. Thank you. That was brilliant. For me, I was just so glued and listening, especially the part that you were mentioning the opportunities to consider the money market, mutual fund, and so on. Thank you so much. That was amazing. So,
Thank you. Thank you.
yeah, thank you. I would like to call on the next speaker, Ngozi Awar, to also give us her presentation.
Okay, thank you so much. Let me share my screen.
All right, thank you.
Okay, hello once again, everyone. Thank you so much for joining us today. So before I speak to my slides, I want to share a short story. So recently, a young girl, reaches out to me on WhatsApp. So she says, "Oh, hello, ma'am. I just got my first job. I earn 80,000 naira. I live with my parents. I showed her some financial responsibilities, in my household, but I want my salary to earn some money for me." So I said, "Okay, let's have a conversation. So what do you need to spend money on monthly? Like, what are the needs that you must spend money on?" So we sat down, we wrote that down. We talked about her wants, like that's items that she doesn't necessarily have to spend money on. Then we also allocated some amount of money from her salary, for investing. So why am I sharing this story? I'm sharing this story because this is a young lady in her 20s. She earns 80,000 naira. She has some family financial obligations, but she still wants to invest some money, and earn returns, on her investment. So this means that no matter your level of income, if you plan, you can actually invest and earn money from your investments. And before you start investing, you should plan. And what is planning really? Planning is understanding your budget and making a budget. So that being said, I would like us to look at, what happens if you have a budget before you start investing, or if you don't have a budget, before you start investing. So we'll look at the cons. So if you have a budget, rather, if you don't have a budget, you risk overspending because you just spend, you just invest as the spirit moves you. Oh, I have money, let me just invest. You lack financial direction. You don't even know what your investment goals are. You hear maybe, money market funds, the yields are high, you put your money there. You don't even know why you're putting your money there, but you just heard people are doing it and you just follow suit. And you might also miss investment opportunities because you haven't done any research. You're just following the bandwagon. But if you have an investment, if you make investment, like if you have a budget rather, before you start investing, you have financial clarity. You'll be confident in your investments because you know why you are investing. You have a time frame for your investments, and okay, no matter what happens, I have my side covered. Like if I make losses in this investment, it wouldn't really affect my lifestyle because I knew that was going to happen. And also you would also have an improved cash flow because you have allocated a certain amount of your income to investing and a certain amount to emergency funds or other funds for your day-to-day activities. So when you have created a budget, the next thing you do is you gauge your financial health. What does that mean? It means you monitor uncontrolled spending and improve your savings. Then when you're done with this, you try to track, not even try, you have to track your finances. You record your income, you record your expenses so that you will know how much you can actually set aside, like I said, for emergencies or for investing. Then you also have to identify essentials. For example, if maybe you use a software for your business and you know that this software has to be renewed monthly or quarterly, you know that, okay, I must set aside this amount of money for renewal. I cannot invest this money at the moment because I will need it in maybe a couple of days' time. Then also you have to spot leaks, find and reduce wasteful spending. If there are activities or items that you spend money on and you know that you can actually live, survive, and be happy without spending money on these activities or items, you cut them out. Now, good financial health is when you have controlled spending and controlled saving. And now, like I did talked about, I did mention the 50-30, 50-30 budgeting rule. I know most of us might be conversant with this, but I want to use the example I shared previously. That's the young lady that reached out to me on WhatsApp. I would like to use the conversation I had with her, to buttress this budgeting rule. So when I spoke to her, remember she earns 80,000 naira. So I told her, okay, so from 80,000 naira, let's set aside 16,000 naira for investments. We did that. Okay, let's set aside 40,000 naira for your needs, like she mentioned that she has to help her family, like shoulder some of the electricity bills. I told her, okay, so from this 40,000 naira, you will take out some money and support your family's electricity bills. From this same 40,000 naira, you take out some money from it and take care of your personal needs, like your personal grooming or your data subscription. And after that, we decided to allocate 30%, which is 24,000 naira to emergencies. Like I did not want her to be left with that money because I wanted her to always have some money in her account in case anything could happen. Anything could happen, and she might need some money to sort herself out. So this was how I was able to help this young lady create a 50-30-20 budgeting rule. So moving ahead, to start investing, you have to prepare yourself. Now, how do you prepare yourself? You define your goals. You set clear financial objectives and timelines. For example, if you decide to invest in FGN savings bonds because the the minimum requirement is just 5,000 naira. You think, okay, I can afford to put 5,000 naira in this savings bond, and you don't even check. You don't read. You don't do your research. You don't know the maturity date for that money, and you just put the money inside. You don't know that money, you cannot get your capital back for at least 1 year, and maybe that 5,000 naira is something you need seriously, like you need that money next month, and you just put the money in your FGN savings bond investment. You might suffer. So that's why I said you have to set clear financial objectives. Okay, I want to invest money. Well, what is the tenure of this investment? Tenure means, when can I get my capital back? That's tenure. If the tenure is 1 year, you will know. If it's 1 month, like in the case of money market funds, you will know. So you have to understand, you have to set financial objectives and also understand the timelines. Then moving on, you also have to be aware of you have to do a risk assessment. Understand your risk tolerance to choose a suitable investment. I'll use myself as an example. I once put 100,000 naira in Coronation Balanced Funds. So balanced funds is a type of mutual funds. So I know that the risk level in this fund is moderate to high. So after I put my money in, and after some months, I lost 30,000 naira of that money. Of course, I wasn't happy, but I wasn't pained so much because I knew what I was getting myself into. I knew the risks were there, and I knew that if equities that the fund invests in does good, I would recoup. And true to what I believed, also after some weeks, I got my 30K back, and I even got an additional 5,000 naira on top of it. So when you want to go into investment, you have to first of all understand your risk tolerance. If I lose money, will I be able to go to bed and sleep peacefully? If not, you have to look for investment options that have lower risk attached to it. Then thirdly, you have to educate yourself about different investment options and strategies. Like I did mention a couple of investment types. There's so many of them, and you can actually find one that suits your lifestyle. And also there are a lot of materials out there, there are academies out there that can help you understand investments, and you choose the one that suits you. For example, in Coronation Group, we have the Coronation Investment Academy. And recently, Coronation Wealth is in collaboration with the NGX, is rolling out free courses to help, new investors, even moderate to seasoned investors, learn more about the capital markets and how to make your investments count. So you can actually scan this barcode if you wish, and you will be enrolled automatically into this course. This course is free of charge. And also on the Investment Academy, there are other courses that will help you build your wealth, help you understand how you can protect your wealth, and also help you know how you can transfer wealth. So all these courses and more are on the Coronation Investment Academy. And also on this academy, you will see the links that can take you to other product services offered by the Coronation Group. So thank you very much for listening, and that is the end of my presentation. Thank you.
Wow. Thank you so much, Ngozi. That was amazing. I like the honesty, because a lot of us are so caught up interest whenever we see investment opportunities. We don't even get to evaluate the risk or even know our risk tolerance. So thank you so much. That was a brilliant one. Thank you for the amazing presentation. Okay, so moving on, I would like to call on Tochukwu Ume for his own presentation.
Okay, thank you. Give me some seconds to share my screen, please.
All right.
Okay, thank you. Thank you, everyone. So I'll try and be very brief just to keep to time. So basically, we're talking about financial literacy, budgeting and investing for financial freedom. And I'll quickly want to delve into it. I would not like to reinvent the wheel because the speakers before me, Ada and Ade, have actually mentioned some basic things about investment. So I may just look at it from a different perspective. I would like to just look at the basics, really. What is financial literacy? What is budgeting and investing all about? Just get the idea. Why should I do this? And the idea is we all want to, why are we investing? We all want to have financial freedom. So what is this financial freedom we're talking about? So a very quick, brief one. So basically, I'll just be talking about financial literacy, what is budgeting, difference between investment and savings, and how can we get financial freedom, and what do we actually mean by financial freedom? But just give me a second to narrate a very short story about the Babylonians' secret to financial freedom. So I don't know how many of you have read this book, The Richest Man in Babylon. Just a very short one. So the richest man in Babylon, according to this book, was a man named Akkad. Okay, and Akkad, of course, was not always rich. He was very poor. He was always struggling to make money. He was a scribe. Like, let's look at it as someone that writes, olden days typewriters, people that type, and a very rich man. Algamish came to meet him to do a very lengthy work, and he wanted the work to be done within 2 days. The book was called The Ninth Law, which is a very, very lengthy book. And he said, can you scribe all this book into clay? Like, more like write it down on a clay for me. I need it. And he promised him to give him 2 extra, let me say in Nigerian balance now, maybe 2 extra naira just to finish it. And he tried his best, he was not able to do it. But the next morning, Algamish was very annoyed and he said, why didn't you do it? And he said, of course, it was very difficult. But because of the desire to get wealthy, to be financially free, Akkad, the scribe, told Algamish, okay, can we have a bargain? So if I'm able to complete your work by tomorrow morning, can you tell me the secret behind your wealth? Okay, and that was a bargain. Algamish agreed. And all night, Akkad toiled and was able to complete the work. So the next morning, he gave Algamish's book, and Algamish was very happy. And he told Algamish, now I've done my own part of the bargain. Can you now tell me the secret behind your wealth? What is the secret for financial freedom? And my next slide shows what Algamish said. And this is just the secret. As simple as it is, it may not be too simple to keep. And he said, a part of all you earn is yours to keep. And I'll repeat that again. A part of all you earn is yours to keep. And it sounded very weird. Like, what does that mean? Like, a part of all I earn is mine to keep. I earn, and all the money I earn, I don't give it to anybody. I keep it. So what does that really mean? So in the course of this presentation, I will speak to that. What does it really mean? A part of all I earn is mine to keep. A part of all you earn is yours to keep. So I'll speak briefly to that, but the idea you have to understand the money language, and that's what we call to be a friend. Active income, passive income, and how can we be financially free? And we also made mention of what is budgeting, what is investing. So I won't want to dwell so much on that. But with what was said, a part of all you earn is yours to keep. What does that mean? Now, if you have your salary being paid to you, but when you go to the salon to make your hair, you have paid the hairdresser out of that your money. when you go to the boutique to buy clothes, you have paid the clothes seller out of that your money. When you go to Dubai, maybe you say, oh, I want to take a vacation, I want to spend on myself, I want to enjoy. You go to Dubai, you're adding to their tourist income. So you see what was paid to you, you are gradually paying it to other people. But the idea is that before you start paying other people, you have to pay yourself. And that is the meaning of all you earn. A part of all you earn is yours to keep. And by keeping it, what do we mean? You are budgeting. First and foremost, you budget. So which part will I keep? And they said, just as my last speaker, there's a 50, 30, 20% rule, which is also here, but I won't want to dwell on that because they have actually said it earlier on. So the point is, what are you keeping for yourself? And when you are keeping money, you're not just keeping it in a safe. How can this money that you're keeping for yourself work for you? And then we'll talk about financial freedom. As I said it here, it is the state of having enough income, saving and investment to support your desired lifestyle without being dependent on a paid job. So when you keep that 20% for yourself, you're not just keeping it, you are allowing that 20% to work for you. Okay, so you are investing it such that at a particular age, you would have had a lot of passive income, not just active income, but passive income. And that's what we talk about financial freedom, when your passive income can accommodate for all your expenses. So you don't have to rush to work. You don't have to be going for a paid job. You don't have to say, if I don't come today, I'll make sure I'll take note and they will not pay me salary. That's not the case because you are financially free. Your passive income is already working for you. And this can only be done by consistently keeping a part of what you earn to pay yourself. And by paying yourself, you are effectively using that money for investment purposes. So that brings me to my second point. Now, when you keep a part of all you earn and you're trying to save it or you're trying to invest it, because you have to save, you have to invest, just like what Ngozi has said, there are two different things. And your income should be divided across those two different things. By saving, you are also preparing for emergency situations or something that you want to, a goal you want to achieve. So if you have your money invested, that investment hours or 72 working hours, it is not instantly. Even if you invest in equities, T+3, it is not instant. But sometimes you put some money in some savings form such that you can always take it as at when it is due. But the point I want to make here is you always need a financial advisor, and that is where we come in as Redwood Asset Management to help you out to invest. For instance, when Akkad kept his first savings, he kept 1/10 of what he earned, and at the end of the day, he gave it to a bricklayer. And at the end of the day, by getting a SEC-approved financial institution or capital market operator, in this case, you can come to us in Redwood Asset Management and we will advise you. You cannot need a drill and you go and meet a bricklayer, or you want to sew your clothes and you meet a carpenter. You have to meet people that have that financial expertise so they can turn your money around and they can make you financially free within a short period of time. Okay, so these are some of the saving rules. As mentioned, we have the 50, 30, 20. I won't want to dwell so much on that. But my best is the 20, the pay yourself rule, which I've always emphasized throughout. The first thing you need to do is always to pay yourself. A part of what you earn is yours to keep. And that keeping is in form of savings and investment. And you save and invest with the right institutions. You are not carried away by ridiculous rates in the market, you hear of CBEX, you hear of MMM. If you have financial advisors, they can advise you properly that these things are not feasible. Someone cannot tell you that you'll make 90% or 50% in 90 days. When no bank is even giving that, so where do you want to make the money for? The pyramid scheme. But if you have this knowledge, they say knowledge is power, you won't fall into. Okay, and I would like to round off quickly because of time. If there's something that you should pick out of this, you can forget everything I've said in this presentation, but if there's something you should pick out of this, is to know the secret of financial freedom, the secret of wealth, and it is a part of all you earn is yours to keep. A part of all you earn is yours to keep. You should get yourself a licensed financial advisor, a licensed asset management firm that will be able to help you grow the money or the earnings that you are keeping for yourself, so that tomorrow you will be financially free and have a lot of passive income that can keep you till whatever time you need, and you can even pass it across to your beneficiaries and loved ones. Thank you for your attention, and that will be all for me.
Thank you so much. That was brilliant, Tochiko. Thank you so much for the awesome presentation. And thank you for that reference, The Richest Man in Babylon. It's a great book, and thank you for how you relate it to the financial freedom, the topic that we are discussing today. Spotlighting that you cannot achieve financial freedom without having a passive income is also a good topic when we are talking about financial freedom, because you cannot dwell on one income and expect to attain financial freedom quickly. Thank you so much. That was awesome. Okay, having said that, I would like to call on Adeze Kinsley Anyanwu for her own presentation.
Hello, everyone. Let me quickly share.
Okay.
But first of all, I would like to thank Business Day and BDTV for this opportunity, and also to put out a disclaimer that although I'm a banker with over 2 decades of experience, I'm not going to be providing any advisory services here. What I would aim to do is to help us understand what I'll be presenting to you, so that you can make an informed decision, essentially. So let me go ahead to share my slides. Please let me know if you can see it.
Yes, I can see it.
Fantastic. So let's dive right in. And it's been great listening to all the other speakers. I thought to present, personal finance. So it's going to be a way of consolidating everything that you've heard. And I will do this in 10 because I've got only 10 minutes to do this. And I'm going to run through introducing you to personal finance. We would also look at the difference between assets and liability, because I realize that this is something that people tend to struggle with. And of course, you've heard about savings and investments. We'll touch on that as well. That 50-30-20 rule, my goodness, if you never knew about it, I'm sure today you've heard it from all of us, and you would start to look into it. With everything we do, there is an associated risk and there is also reward. I like to put the word potential before reward. Although you hear high risk, high reward, it's important to understand that things do change, similar to what you can see happening globally. So you never can predict what's going to happen in the future. And of course, we are all planning for retirement at some point. So we'll touch on that as well. So, what is personal finance? It's important to understand that you are unique, your circumstances are unique, and so you shouldn't compare yourself to anyone's circumstances or to anyone at all, whatever strategies people are using. And look at the fact that over the years, you have received income in different forms, whether you're in paid employment or you're self-employed, or you have actually invested in some assets and you've earned some income across those assets classes. And by the way, income doesn't necessarily mean that you're paying yourself a salary if you're self-employed, or that you're earning a salary from another company. You could earn income from rent, meaning you have bought a property and you have rented it out to someone. And so you receive what is called rental income. A lot of the speakers have spoken about investing in stock markets, for example, where you earn dividend. That's an income in itself. So when you receive all these income from different sources, you should also look at it as something that you can use towards your personal finance, because all we're doing here is just to provide you with all of this information to give you the level of freedom that you want to be able to do anything you wish to do. It's about managing your money. So look at it again as stewardship. All the money that you have received over the years, that you've made over the years, how have you managed them? What have you used all this money for? That's a question you should ask yourself. I like people to ask those sort of questions, because that then starts, telling you or helping you identify where you need to make necessary changes. I'll just quickly move on to this photo I have here. It's really about helping you understand what is an asset and what is a liability. And it's as simple as this. Anything that puts money into your pocket is typically an asset. Anything that takes money out of your pocket is a liability. And it's as simple as that. Now, I've put all these pictures here because these are things that we're most likely familiar with. Look at the car. I love Mercedes-Benz so much, If I bought that car from a Mercedes car shop and I drove it out, it starts to depreciate. It starts to lose value. Miles start counting. So if I were to sell it to someone else a month, a week later, it would not cost the same amount. But what would make this an asset for me instead of a liability would be if I decided to put this car into a car hailing service, like Uber, for example, or any other one that you're familiar with. Or if I sold this car, of course, an income comes into my account, right? I make money from it. And so it becomes an asset to me in that instance. But the moment you drive it away, like I said, you're maintaining the car, you're fueling it, you're servicing it on a regular basis, it's a liability. Look at the house as well. And there's nothing wrong with buying a house, living in it. But would you consider it as an asset or a liability? It's an asset to you when you rent that house out to someone and you're receiving rental income. So long as you live in that house, it's a liability because you're constantly paying bills. You're also maintaining that house. And I would also like you to think about every other photo in here, all the other items here. What would you consider cash to be? If you like to invest in gold, what would that look, what would that look like for you? So I'll quickly go to the next one. We've also talked about savings and investments, and everybody talks about investing. Whilst it's good, I think it's important, like the other speakers have also said, to set those SMART goals, actionable goals. And it's not just about listing the goals. You have to also make sure that you carry out some of these things that you have promised yourself. It has to be specific. It has to be measurable. Okay. And you have to just make sure that you have something that is realistic. You have to give yourself a time to be able to achieve these goals as well. Now, in order to carry out the goals that you have also set for yourself, you have to look at how you're able to approach risk. So we talk about risk profile. We talk about how you can actually deal with issues that happen in the market. So if, for example, you invested in the stock market and what happened in 2008 repeated itself today, how would you absorb that issue? Would you be someone who would give up completely in investing, or would you still carry on with investment? How would you take that sort of condition? So it's important for you to risk profile yourself. Would you rather invest in low risk instruments, or would you look at things that are medium risk, or are you someone who is a high risk taker? Are you really aggressive? So you have to determine that about yourself. And in doing so, we've talked about budgeting. You have to know exactly how much of your money is going to each of these things that you want to invest in. And of course, you should also be able to determine how long you want to stay, in those investments. How long do you want to keep your money in those sort of investments? And it's also encouraging to see, that you automate these investments. Because if you don't, the money would obviously be used for something else. So it's always important for you to automate your investments. And you can also invest in whether it's real or financial assets. And real is just something really tangible. Are you looking to invest in properties? Are you looking to invest in the financial markets? You've heard about all types of instruments that you can put your funds into. And like I said, with every investment, with everything we do, the risk and element of risk. And there is also the reward that comes with it. Emergency fund is something that we would look into very shortly. We've all talked about the 50, 30, 20 rule. This is just a template, really. It's a framework for you to work with. We receive income from wherever, whether, like I said, you're in paid employment or you are self-employed. But it's important for you to split your money, appropriately so that you can also achieve everything you want to achieve. You can meet your aspirations, your objectives, your personal finance objectives, essentially. And like we know, most of our money would typically go to what we need. What exactly do you need to do or spend money on to survive? Essentially, that's why this pie would typically have half of it split, for your needs. And then the remaining half is split into your wants and your aspirations, essentially. Of course, your needs would include, we've talked about it, you have to pay rent, you have to eat, you have to pay your bills. There's some really important things that you have to do to survive. And your wants typically would be those kind of things that you want to do. Maybe you want to splurge on yourself, you want to travel, you want to buy a car. You have to look at the different options, the one that would really be affordable for you so that you're not overly spending your money, because you can actually cut back on some expenses so that you can then put more of the money into your future aspirations, essentially. So it's important to try and use this. However, it's not cast in concrete. You can decide to tweak it depending on how you're able to manage your money ultimately. So it's important. Again, it's not a one size fits all, and we all have different circumstances to deal with on a day-to-day basis. However, just like the other speakers have said, it's important for you to also engage the services of a financial advisor, because they are the ones that are competent with the right level of skill sets, and they understand how to help you allocate your capital across, these needs, wants, and your future aspirations. I did talk about risk and reward, and that can apply to you as a person. What sort of risk profile do you have, and what sort of, where are you putting your money? The markets are split into, low risk, medium risk, and high risk. And I've given some examples of, some of the things you can put your money into by way of investments. But like I said, you have to make sure that you have those goals that you want to achieve before you start to look at these things. And again, ensure that you engage the services of a professional financial advisor. And of course, retirement is, really important to plan for, because there would be a time when you're not actively working and you would need to live on, or at least maintain the lifestyle that you're used to. And so you have to think about pension. If you're in self-employment and you're not paying yourself a pension, I think it's about time to engage the experts and make sure you start to pay yourself a pension. This is towards your future. We've talked about budgeting. We can't overemphasize this. It's really important. The 50-30 rule is the basic split for your money, or you can tweak it, like I said, to suit your own circumstance. Banking, of course, you can't put your money under your pillow. You have to ensure that the money is in a bank before you even start thinking about saving and investing. And of course, you have the options of buying a property, using a mortgage from a bank, and you have to protect everything that you've worked for over the years and even what you want to pass on to your beneficiaries, for example. And it's important to be on the right side of the law by making sure that you know exactly what your tax liabilities are. You need to be able to contact or at least engage with a tax consultant to help you ensure that everything is watertight and that you're paying to Caesar what belongs to Caesar, as they say it. Now, estate planning and management is another wide area that you need to look into, because that also encompasses everything that you want to do with respect to all the money you've worked for over the years. How do you want to be able to, put that across to the next phase of your life? How do you want to administer all that you've worked for, to your beneficiaries and loved ones when you're not here, or in case of incapacitation, for example? So that's pretty much it. Financial literacy is really what we're here for. We want to be able to equip you with everything that you need to be able to make the right decisions. And for me, I believe it's important to read as much as you can, carry out as much research as you can. And one book I must encourage you all to read is Rich Dad, Poor Dad. If you have read it before, try to refresh your memory, pick it up again and read it. And if you haven't, you should pick it up and put it on your shelf as one of your financial books. It's about financial literacy. It's about equipping you, like I said. Breaking Free from Broke is also another interesting one I believe you should pick up. And The Intelligent Investor. That's where I would end it today. Thank you so much for listening, and I look forward to your questions.
Thank you so much, Daisy. Thank you. That was awesome. Thank you for also giving us another book to look into, Rich Dad, Poor Dad. And also, thank you for highlighting the need of automating your investment, because we see a lot of cases where, okay, we are we are told to invest. Let's say you invest about ₦1 million, and by the time your money yields, you take it out with your interest and also the main money that you put into the investment platform, and at the end people don't get to like invest it back, and that is just the end of it. So thank you for spotlighting that, automating your investment. Thank you so much. It has been an awesome one, and I look forward to the Q&A. So having said that, I would like to dive straight into the Q&A section, and I'll be calling on our speakers in no particular order. So I would like to start with Ngozi Awa. I know you talked about risk tolerance, so that's why I want you to particularly answer this question. So here is the question. What is risk tolerance, and how does it impact investment choices? I will take that again. What is risk tolerance, and how does it impact investment choices? Hi, Ngozi. Can you hear
Okay,
me?
thank you so much for that
Okay.
question.
All right.
So, hi. Yes, I can hear you. Okay,
Yes, I
you can
can.
hear me now, right?
Yes, loud and clear.
Okay. Okay. So I was saying that, risk tolerance, it reflects on how you can emotionally and financially, handle investment losses. So what happens when you invest in any asset and you make losses? How do you handle it? Does it keep you awake at night, or does it stress you out emotionally and mentally? So you have to understand your comfort zone in investing. How much can I invest and it doesn't affect my lifestyle? How much would I lose in an investment and I can still go on, living and meeting other financial obligations? So that's, in a nutshell, what risk tolerance is about. And how does it affect your investment choices? So if you are not open, to making losses in investments, it's advisable to look for investment types that have low risks, like mutual funds, for example. But if you are comfortable, you don't mind losing sometimes and gaining a lot at other times, you can also tilt towards the stock market. But like I would say, I'm just giving an example. I'm not trying to advise anyone on types of assets to invest in. I'm just giving you an example. If you decide to invest in any asset, you have to do your research. If you're not comfortable or confident in the information you have seen online, you can easily consult a financial or investment advisor to put you through. Thank you.
Thank you so much, Ngozi. Thank you for spotlighting the risk tolerance and how it impacts our investment choices. So our next question, I would like Aditayo to answer this one. Okay, so how can individuals balance short-term needs with their long-term financial goals? I'll take that again. How can individuals balance short-term needs with their long-term financial goals?
I think that's a very interesting question. Um, hmm, balance. I wouldn't say, I don't know if there's a balance. I think it's more from a thing of discipline and disciplining towards the goals that you have. Because I would kind of akin it to work-life balance. I guess you can't necessarily agree that you can get work-life balance. You find the balance inside the work. So you need to find the work enjoyable. So with that same vein, I think it's mostly from understanding your own spending habits, right? Because if in the short term you need money, right, for certain things, you need to be able to save or invest the money that you know would not affect you. I think Ngozi gave a fantastic example, right? You put 5,000 into a bond or lock it away in treasury bills, for example, that takes a year to mature. But you know you need that 5,000 in 2 months. It doesn't necessarily make sense. So I think it's understanding what your own objectives are and your spending habits or what your spending calendar is going to look like. If your rent renews in 2 months, it doesn't make sense for you to invest that rent money in treasury bills, for example, or lock it in a fixed deposit for a year. So understand your spending habits, understand your own particular goal, and invest accordingly. So I don't think there's necessarily a balance. It's more of understanding what you want to do with money and choosing the right investment options for your objective. So yeah, that's it. That's the short way to answer that.
Okay, thank you. Thank you. I like question, and this one would be for Tochukwu Ume. Okay. So what's the role of diversification in investing, and how can individuals achieve it? I know you talked about mutual funds and euro bonds and other investment opportunities. So what is the role of diversification in investing, and how can individuals achieve it?
Okay, thank you for that question. So basically, when we talk about what's the role of diversification, it just reminds me of the magazine which says, "Do not lay all your eggs in one basket." Okay,
Exactly.
so by diversifying your investment, you are saying that, okay, I want to put some investment in a particular asset class. I want to put another investment in another asset class. I want to put another investment in another asset class. But just as the earlier speakers have said, you need to know what is your risk tolerance. And just to add to what she said, you could be either risk averse or risk seeking. So if you are risk averse, that means you are afraid of taking risks. And if you are risk seeking, that means you really want to take risk. Okay, so your risk appetite is high if you are risk seeking, and if you are risk averse, your risk appetite is low. So this will also influence your diversification ratio. Okay, so your risk tolerance will influence that. Your income level will influence that. You can't expect somebody that is making maybe 100,000 annually to be taking as much level as risk of diversifying his portfolio in a much aggressive way than someone that is making 1 million, 2 million, or 3 million per annum. So your income level also matters, even your age. Okay, are you still a young person? Are you getting towards retirement? These factors all combined will influence your level of diversification. So, but the idea is that you don't want to lay all your eggs in one basket. You want to invest, for instance, maybe 80% in a money market fund, which is quite safe. You want to invest maybe 10% in a balanced fund. You want to invest another 10% in an equity fund, or in an equity asset, as the case may be, or in equities as a whole. So this influences your diversification decisions. So I think basically, I think I've addressed that. How do you diversify? So if you want to diversify your investments, I also think the first thing is you have a financial advisor that can advise you accordingly, advise you properly on which particular investments do you want to invest in based on your long-term decisions or your long-term objectives, even your short-term objectives, and based on the other factors I've mentioned, your risk tolerance, your income level, and your age at that particular point in time. So basically, that's what diversification is all about. And I'll just give a very brief case study, just like what Adeze mentioned. There was a meltdown in 2007, 2008 financial crisis in equities. Imagine if all your funds were in equities at that particular point in time, you would have lost all your money. But people that might have diversified will still get some comfort in other investments that were not fully, or that were not in equities but in other asset classes. So that's what diversification does. It just helps to prevent situation whereby one of those asset classes go down, and you will not lose all your money because you have other asset classes that you have put your money in. Thank you.
Thank you so much, Tochukwu, for that brilliant answer. Thank you for speaking more about diversification and the need for us not to put our heads in one basket. Thank you. That will bring me to the next question. Over to you, Adese. I know you spoke a lot about having a retirement plan, so that's why I specifically picked this question for you. Okay, so here's the question. What's the importance of having a retirement income plan, and how can one start building one? Let me take that again. What's the importance of having a retirement income plan, and how can you start building one? Hi, Adeze, can you hear me? Okay, so
I
why?
believe she's dropped off. Yeah, I
Yes.
think she's looking.
Okay, so while we wait for her to come back, we are almost we have almost exhausted our time. So I would just like to take one more question, but this time we're just going to be brief about it. So I would like each and every one of our speakers to just give us one advice that you want to give someone starting out their financial journey. I know we've spoke a lot about financial freedom, financial literacy. So what is that one advice that you will give someone that is still starting out his or her financial journey? So okay, I think Adita, you can go first. A round of
Okay,
okay.
thank you. So I believe it's. Oh, were you saying something, sir?
No, that's you can
Or should
go
I
ahead.
go
I
on?
just wanted to say that that is like our round of question for this section.
Round up. Oh, okay. Okay, fantastic. So I believe it's primarily if you're just starting out investing, there is no rush. That's always the advice we would give. I would give particularly. There is no rush. Take your time. Markets would always rise and markets would always fall. Take your time, do the necessary research, understand your position and where you stand. All the speakers they have spoken to that, understanding your position, which essentially how much risk are you willing to let go of, how much money are you willing to lose. Take your time, do research, understand your position, then take action. So before you make any investment decision whatsoever, ensure that you are fully researched, you have enough confidence in the investment choice you want to make. The research you're doing is also to ensure that whatever it is that you're doing is with a licensed and regulated body. So whoever it is you're choosing to invest with, whatever application you're choosing to put your money into is regulated and licensed, and then take action. There's no need to rush. Anybody that chooses to take anything is probably largely going to be a Ponzi scheme. Well, yeah, that is all I would have to say.
Okay, thank you so much, Adetayo. If I heard you clearly, you said take your do not rush, and if need be, seek financial help. Thank you so much. So over to you, Ngozi. What is one advice you have for someone starting out their financial journey today?
Okay, thank you so much. So what I would say is before you start investing, take out time. You can take 1 month to track your spending, you know, understand your financial habits and also look out for areas, for improvement. And like what me I do, for example, is when I go to the supermarket, and buy stuff, once I get back home, I take my phone, I go to chat GPT, I just take a picture of the receipt and tell it extract all the items in this receipt and sum it up. So and right now, once I go to my search, the search option on the app, I click on receipts. It opens up. Then I can see like all my expenses for the week, for the day, everything is there. I can even ask it, okay, can you just sum up the amount of money I've spent maybe on the 15th of July? It does that and it shows me. So I can easily, keep track of my expenses using that tool. So that's something I would advise, newcomers to investment to do. Use a tool or any app that you can to track your expenses, your financial habits, then look for how you can improve, you know, how you treat money. So thank you very much. That's it from me.
Thank you so much, Ngozi. That was a brilliant one. Thank you for spilling that tea, how you track your expenses. I'm definitely going to try that because I think I go to the supermarket a lot and I haven't thought about doing that. So thank you. That was a good one. Okay, over to you, Tochiku. So I bet to differ from the question. So I would like you to say what is like just give us one myth that you want people to debunk today about investment. I know there are a lot of them that is flying around, so just briefly tell us the one that you feel people should debunk after this section.
Okay, thank you. That's a very interesting question. I thought you'd give me what you're giving others.
No.
All right. So the myth, very interesting. So to me personally, is that if you start investing today, you become the richest man in the world or the richest man in Nigeria, or you become rich, as the case may be. So everybody wants to invest because they want to be rich, 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 rich. and they think it's a very fast or quick process. So you see the young guy out there, what will I invest in? What will I invest in that will just make me a millionaire overnight? Okay. And that is the myth I want us to really debunk, to bust, that investment takes time. Okay. Investment takes patience. It's a process. It's what we call compound growth. Okay. Compound return. So it is more of a compounding thing than a linear return. Okay, so it takes time. The richest men today in the world, if you look at the Warren Buffett, they did not just climb there. It takes patience, it takes time. And this myth is what is causing a lot of people to patronize all these unscrupulous and unrealistic high returns. You see 50% ROI on 30 days. You see CBEX too, you see MMM. Because of this myth of wanting to get rich quick, and investing is the way of doing that, a lot of people fall into these traps. A lot of people get their fingers burnt, as the case may be. So if people can understand that investment is not an overnight thing, you don't just become rich tomorrow, you sleep and wake up, you are a rich person. It takes time, it takes patience, it takes consistency. It's a thing that has to do with compound growth, compound returns on your investment, and not just an overnight return that will make you very rich. So if people can understand that patience, consistency, growth is what makes you rich at the end of the day, not something that is you just close your eye, wake up, or you like, there's a way they put it, like a magic wand. It doesn't happen like that. So I think people should get that into their subconscious, and know that ridiculous rates won't make you rich. They're only out there to lure you in and then take all your money away. Thank you.
Thank you so much, Tochuko, and thank you for that closing line. I think there are a lot of informations out there where, a lot of young ones, people think that investment is just, oh, putting your money today and tomorrow, boom, you're rich. But I like that fact that you debunked it today. Investment takes time, it takes patience, and it also takes discipline for you to attain financial freedom. So if you're starting out today or thinking of starting out your investment journey, don't forget to always start small. Evaluate your risk tolerance and make sure that whatever you're investing your money into, you understand everything about it. And if you don't understand, there are a lot of informations out there, and you can also seek financial advice. Thank you so much. Thank you, my brilliant speakers. It has been an awesome one today. Like, I've just stayed clear from the beginning till the end. And to my amazing listeners that stayed through till this end, thank you for being here today. Thank you for joining us. We are truly grateful. And I would like to draw the curtain here. I am Ethel Adorno. Thank you for joining. And until the next edition, do have an amazing day. Thank you.